Good morning, everyone. Welcome to this update for global stocks and commodities for the 15th of December. We came into the week with three big events that could have had a significant impact on markets. The first was the Fed meeting and the Fed statement. And in the end, they left interest rates unchanged, which was pretty much expected. The second one was the UK election. And we now know that Boris Johnson has won that, so that means that we now have certainty around Brexit. And the third one was the US-China trade deal, and if a deal couldn't have been done, at least in principle, then there could have been more tariffs applied basically as of today. So all three of those would appear to have been removed, although I guess the Trump is so unpredictable that the trade war situation is very much day to day. But certainly the outlook is more positive now, and it would appear that some sort of phase one deal has been reached between the US and China. So with those three big uncertainties removed for the markets, we ended up with a new all-time high in the S&P, and we've got reasonably buoyant markets around the world. So it certainly looks as though there's nothing that would get in the way of a reasonably positive end to the year, and certainly much better than what we saw in 2018, which was obviously a real bloodbath because everyone was convinced that interest rates would be going up. So this update, there's now every reason for markets to keep rising. The uncertainties that have been around for a good part of the year, really, have now been removed. Portfolio Analyst last week, I looked at managing capital raisings in the 10-bagger portfolio, which obviously causes some volatility in the share price and consolidation. So managing that from an emotional point of view is always a subject worth focusing on. So the net result has been that despite the capital raisings, the companies that did so in the 10-bagger portfolio still continue to perform in a very positive fashion. All right, so the American stocks last week, the S&P managed to gain 23 points, 0.7% across the week, and that makes it 9 weeks out of 10 of gains, so a very, very positive finish to the year. And it's really been all year, and in fact for a couple of years, it's been an amazing performance against what has been consistently poor sentiment. And that has really been the case since 2009. That everybody has been waiting for the next shoe to fall, for the next disaster to come along, because that's what the media has been feeding us. And those that have stayed out of the market or been very nervous about the market because of that have, I think, their performance has suffered. There's no question about that. So it's really quite an extraordinary bull market. It's now, if it's not the longest, it's very close to it. If it's not the biggest, it's very close to it. I just can't remember the exact numbers. But we've been running now for a decade or more. And the whole thing has been against terrible, or basically terrible sentiment. And I think that's the reason that it's been able to go on for so long, is that, the retail consumers and businesses have just always been apprehensive about what would come next, what would government policy do. And as a consequence, the market hasn't ever really gotten ahead of itself. And so that's led to a very sustainable bull market. And frankly, it's really hard to see how it's going to change. As long as there isn't some sudden euphoric breakout, there's no reason why this can't continue for a few years yet. I think what the events of the last few weeks and few months have resulted in from the US-China trade war is that it's probably killed the possibility of an escalation in the trade war. That would appear to be probably off the table now. And so markets can get back to worrying about what they should be worrying about, and that is earnings growth and economic health. And in the States, as I've been saying for some time, you can find things that are wrong, you can find negatives, but it's been good enough. It's been good enough to sustain the trend. Valuation is not an issue because prices have basically risen with the profits and what are reasonably solid fundamentals. So if you want to read a negative case and why the market will top out here and fall, then it's very easy to find. But I'd really encourage you to ignore that sort of reporting because it's been around for years and years and years, and all it's done is cost people a lot of money. So the valuation issue to me is not a particularly big issue. There has not been any euphoria from 2009, and there still isn't. And under those circumstances, as long as the world doesn't fall into recession, and there certainly is evidence that we've seen the lows, then there's no reason why this bull market can't continue. Some corrective weakness will come along, but frankly, why worry about that? You look at the severity of the correction we had at the end of last year in the final quarter. I think the S&P was down just a touch short of 20%. But look at where we are now, and I'll have a look at that chart when we jump onto the chart. So even a substantial pullback in the market, didn't derail this bull market. So try to avoid some corrective weakness in the market. 8% corrections is just a complete waste of time. It's just too hard to do. So if that's what you're trying to do, to jump in and out of the market around these corrections, then I'd really encourage you to stop doing it because you're going to mess it up. Just about anybody's going to mess that up. It's too hard to do. The US dollar finished lower as a consequence of the Fed really indicating that interest rates are probably going to stay stable throughout 2020, and that we may even only see one or two rate rises through to 2022. So that took a bit of heat out of the US dollar. Trump is getting what he wants, lower US dollar. So we're back to the Goldilocks scenario again. The 10-year yield was steady at 1.82. Let's take a look at the S&P chart. So you can see, let me just go back to the final quarter of last year. Okay, so this was nasty from the 4th of October basically to the 24th of December. You can see the market fell very sharply from 29.30, got to a low of 23.50. So that was nasty. And certainly that was one that was worthwhile stepping aside from. But these other corrections, like here we had throughout May, another one in August, and another very short one through the later part of September, you just really want to soak it up and just let the market do what it's doing. Trying to avoid those is really not a high probability play at all. We're also seeing good strength in the small caps as well. So this breakout from a lengthy consolidation in the Russell 2000, that has been sustained as well. We got a pullback to retest the breakout and then off again. So it's all pretty positive. US dollar, you can see we're still really in the uptrending channel. Perhaps we could just move this trend line a little bit. It's looking like we may break that uptrending channel, but then again, we may not. So it's sort of a little bit touch and go at the moment. Certainly, Trump would like to see it down around 90. Whether he gets his way or not remains to be seen. So that's where the US dollar is. Now, as a consequence, it did push the Australian dollar up, and we've now broken, not terribly emphatically, because if you look at it's a single day and the volume was actually really low. So I don't think there's anything particularly emphatic about that. But we have sort of risen to the top of the downsloping channel in the Australian dollar. While I'm here, let's look at the ASX 200, and we're still just in a big consolidation wedge here with the banks under pressure. It's hard to see what would cause this to break out. if I had to pick any part of the top 10 or 20 stocks that could take the index to a breakout, you've just got to go for BHP and Rio. I think, and that's not a recommendation and it's not a prediction. But if I had to pick something that was more likely to move up than not, then I would go for BHP and Rio. But that is not with any level of conviction at all. So our dollar finished 68.7. Our index rose by 0.33 on the week, 33 points on the week, 0.4%. And, the miners do look the best of the top 20, but with no conviction on my part. All the big progress is being made outside of the top 200. There are a few stocks in the top 100 that are high conviction stocks of mine. There's a few more in the top 200, but most of the action is in the ASX 300, or even a few that are outside that. And that's been the case in the Australian market for some time. If you want to produce really outsized performance, then you've got to look outside the top 100 by and large. All right, turning to precious metals now. Gold was quite volatile, but ended up rising $16 and finished at $14.76, and that was a fair bit about the US dollar going down. Now, the overhang in the futures market, which I've been talking about for some time, still applies. It hasn't really been washed out to any great extent. The selling potential, therefore, in the futures market, which does really control the short-term price of gold, that selling potential is still very big, because the speculative longs are at about the 98th percentile of where they would normally be. It's still close to 400,000 contracts to the long side and very few contracts to the short side. And that means that there's very little buying left compared to the amount of selling that could occur. Now, it's really interesting why we've got this situation, why we've got this really substantial overhang, but it just doesn't want to let go. I think is partly because of what gold did from the September high, because it ran up so fast. And the shifts in the geopolitical issues and the change to the interest rate trajectory has certainly had an impact on on the short-term price of gold. And we shot up into the September peak more than I think was probably warranted. So gold actually got ahead of itself. And so we've now got gold left dealing with a surge that was just quite unusually robust. It took us to this really high level of extreme on the futures market. And certainly in terms of percentage gain, it was one of the strongest gold legs that we've ever seen. So that was unusually robust. And as a consequence, we've still got this overhang that's just sort of holding it up there. And then, of course, we've got the seasonality coming in as well. This is a peak buying period for gold. So when we look at precious metals, GDX is obviously the easiest proxy for the gold mining industry as a whole, and it's been consolidating high. So GDX ran up very strongly in response to the gold price going up, and hasn't pulled back to the degree that it normally would do. And so what we've ended up with is, instead of the normal sort of pullback, we've actually headed into what is a compression triangle, and we'll take a look at this shortly. And so we're at this point where the correction is really just too mild. You almost always get a correction down to below the 200-day moving average on GDX. This time it hasn't happened, and it's all because of what I've written above. So we've got this market that's sort of on a knife edge, and basically the risk reward just remains really quite unappealing. So, I think it's fair enough to hold some exposure to gold as a hedge against disruption, although, now with Brexit and the trade war and the Fed sort of sidelined in terms of triggers for the market, then the fear factors come out as well. So, it's just really an unappealing situation, because if the futures market does suddenly let go for whatever reason, it becomes a self-fulfilling spiral because of the incredible leverage that futures traders use. So even though they might think that gold is going up in the future, they can't afford to hang on because their leverage is so high that it forces them out. And so what you get is a small spiral can very quickly build into a big spiral. And that's the part that sort of makes me nervous about the gold market. All right, let's take a look at some charts. So we'll start first of all with gold. And this is on a weekly basis, and you can see that at the one level, this is a wave 4 consolidation. It's longer, it's more complex, meaning more ups and downs. It's messier, it's harder to read. So it's doing that, and it's been doing that since the middle of August. So this is quite normal. And if we look at it on a daily basis, then you can see that we've had quite a bit of volatility, and we've got really a bit of a downtrend, a bit of a downtrending channel, but nevertheless, it is consolidating reasonably high compared to what gold would normally do. Now, if we go and look at GDX, so here's GDX. Any other time that it consolidates and pulls back, we saw a pullback here in April, pull back to just a whisker below the 200-day moving average. This time it's held well above it. In fact, it's still holding above the 50-day moving average. So it's this high-level consolidation that is sort of, not offering a good risk-reward opportunity in my view. So the gold market, I think it's prudent to hold a bit, but you certainly don't want to be going too hard on gold at this point in time. Other commodities, copper rose to 277. Okay, a bit of currency effect there as the US dollar fell, but the net result has been that it's burst out of the consolidation zone that it's been in for many, many months. And it's finally responding to what has been a pretty decent slide in the London Metal Exchange inventory. So inventories go down, the copper price should go up, all other things being equal. But of course, we know that all other things aren't equal. There's many things that are influencing the price. But certainly I would have expected copper to have risen before it did, as you'll see in the chart. But nevertheless, we've burst out of consolidation, and that's certainly a positive for BHP and Rio, the copper price. Obviously, the iron ore price has an outsized impact as well. Now, crude oil rose further to 59.76, and that was really more currency than anything else. So not a lot of independent movement in the oil price. There's the spot copper chart. You can see we've been in consolidation here below $2.70 since the middle of the year, in fact, late May or mid-June area. And we've finally managed fairly strongly to burst out of that consolidation. And here's one of the reasons why. We've been on the slide in the inventory levels in the London warehouse since probably September. Probably ignore this little bit because that wasn't definitive, that we were going back into a downtrend. But certainly the downtrend has been in place the last 3 or 4 weeks, and the price has finally started responding to that. Now, if we look at nickel, it's we got this euphoric burst because of the Indonesian government moving their bans forward on the export of raw nickel, and then we pull back. Probably a fair price is probably somewhere between 650 and 7, all factors considered. We overshot to the upside, we overshot to the downside, and now I reckon we'll probably level out somewhere in this $6.50 to $7 a pound, which is pretty profitable for any sort of decent miner. So that's certainly a space to watch. So to wrap it all up, And this is exactly what I wrote last week. When I reviewed it again this morning, I just couldn't find anything more appropriate to say. So I thought I'd run this again. The safe and efficient way to make money in this environment is you've got to act to a degree when it feels uncomfortable. If your potentials are quality growth stocks, if you don't know how to find them, then you better hook yourself up with someone who does. And when you get the best results is when it feels uncomfortable to go into something, because generally that means that the price has fallen back, and there is some negativity out there, and that's when the best results come. The second point is that I think you've got to accept that many traditional stocks, many top 20 stocks, top 50 stocks in Australia, they're not going to cut it in terms of performance, and some of them are going to be downright dangerous. And we've seen some very, very substantial hits to top 50 stocks in the last 12 months. You need to develop a watch list of really high quality and high probability growth stocks. It's not just high quality, because you don't want a high quality stock that just goes nowhere and may in the end have to decrease their dividend because their profit growth is under pressure. You also want high probability growth stocks. So the growth is going to be there with a high degree of certainty. So you need to develop that watch list or hook up with someone who can develop it for you. You then need the patience and conviction to buy after bursts of selling. And look, that's not easy. It's not easy for any of us to do that. But the higher the conviction you've got around the stock, then the easier it becomes to do it. And that is going to be the difference between just struggling along, getting so-so results, and getting truly excellent results that can really change things for you. Portfolio Analyst coming up. I haven't decided what I'm going to do this week, but look, rest assured, there's just an absolute truckload of really exciting things happening, really exciting possibilities in the Australian market and some in the US market as well. So there'll be some pretty good stuff in Portfolio Analyst this week. There's my contact details for anyone that is not a member and wishes to communicate with me. And I'm not sure about whether there'll be a video next week or not. It'll probably be a bit market dependent. If I've got something to say that's worthwhile, there'll be a video next week on the 22nd. But otherwise, I'll be back with you in the new year. In the event there is no video next week, I would like to wish all the people that have viewed this ongoing video, which has now been running for in excess of 10 years. I enjoy doing it. I hope you really get something out of it, and I wish everyone all the best for the Christmas New Year period and all the success that you may want in 2020. That's it for this week. Cheers.